in a change of pace for share markets both locally and globally, last week we saw both the Australian and the US markets finish flat for the week, back to where they started. But that flat performance over the course of the week masks a big change in behaviour. Now, it is true that once again the US market hit an all-time high last Monday. But then unusually, it had 3 down days in a row, and we haven't seen much of that sort of market action in the US. Now, interestingly, again, the Australian market proved resilient through that pressure on the US market. The only down day in Australia was the Wednesday, and we're up all 4 other days in the week. However, that big fall on Wednesday erased all the gains on the other 4 days, and a similar situation played out in the US, with Friday's rally bringing the markets back to where they'd started the week. So a flat week, but not without action. And a lot of it was around the macro. It hit individual stocks, and we had very mixed results. And a lot of the action we saw last week, particularly in those big US tech stocks, was about mean reversion, about reversing previous big moves. So one of the biggest fallers, Oracle, down 8%, was one of the previous week's biggest gainers. On the flip side, Apple, which had been under pressure in the previous week, was up 4% last week. So we did see some mean reversion, some realigning of relative valuations, particularly within the tech sector in the US, but that played out across the market as well, as the reporting seasons we saw all around the globe continue to echo through the daily trading behaviour. Of interest last week was the pressure on the Hang Seng heading up to mainland holidays starting this week. We saw a very weak performance. The Hang Seng down 1.6%. BYD, one of the stars of the performance so far for the year, was down 5%. So plenty of pressure there, and it did look like some investors locking in ahead of what might be a lighter trading season during Chinese holidays. This week we will get an interest rate decision from the Reserve Bank of Australia that will be delivered after their meeting at 2:30 Tuesday afternoon Eastern Time. It's widely expected there'll be no change to interest rates at this meeting, but that the RBA will lower rates by 1/4 percentage point on Melbourne Cup Day. That is in the first week of November. So the statement that's released with the decision tomorrow will be watched very closely and examined for any hints that presumed and consensus forecast interest rate path might not be the case. And if, on the other hand, the RBA does confirm an easing bias and a high likelihood of a rate cut in November, we could see a positive reaction, particularly in share markets. But it's an interesting one to note because on Friday night in the US, we saw inflation data. Now, the inflation data on Friday night was only the monthly read, and the monthly read is less valuable in looking at the market for 2 reasons. First of all, it's a much shorter term snapshot, so it's a much choppier read. And secondly, it's a much smaller sample size. This really is more of a survey, more of an estimate than a survey. And so the monthly read doesn't often get a lot of behaviour. But with the high sensitivity of markets to the outlook for interest rates, inflation and jobs data will be a key focus for the rest of the year, and was in focus on Friday night because of that. And the good news from a share market point of view was, although inflation rose at both the core and the headline level, the rises weren't as bad as the market feared. And so share markets rallied on that news because things weren't as bad as they thought. Now, interestingly enough, gold went with it. And although gold did edge below $3,800 an ounce, it's still within 0.5% of its all-time high. And platinum hit a 13-year high in trading on Friday night. So precious metals and share markets seem to interpret this inflation data as meaning no impediment to lower interest rates. But that was not the case in every market. And in fact, we saw pressure on bonds with yields rising, prices dropping, and in the currency markets. And perhaps most important was the reaction on Friday night was the big gains for the dollar against the yen, up above 149, and against the euro, slipping below 117. So that dollar strength says that currency traders believe the benign interest rate outlook that everybody is counting on might not be the case. And the moves we saw in bond and currency markets suggest those two who are highly sensitive to macro developments, those two markets are suggesting that this idea of plenty of rate cuts to come in the US might not be the case. And if we continue to see bond and currency markets pushing away and reflecting a less likelihood of interest rate decreases and possibly even tightening, the impact on share markets, if they start to price the same scenario, could be very dramatic. And so this situation must be resolved. Both of these markets can't be right. Both of these views cannot be right. They are mutually exclusive. And if share markets move towards the bond and currency market view of interest rates, the corrective moves in share markets in the US and around the globe could be very, very substantial. So turning to our watch list for today, first cab off the rank is Starbucks. It announced last week it'll be closing stores. It's restructuring at an estimated cost of $1 billion. 900 staff will be sacked, and the stock has been down. The stock's been under a lot of pressure, down 11% in 60 days, well down from the highs we saw around 117 in February this year to be trading around $83 a share. So that pressure has been ongoing. And it does appear that the announcements last week were aimed at short-circuiting Starbucks woes. And the share price did reflect that. It appears to be stabilising around those lower levels. Clearly, restructure with efficiencies in mind is a positive from a shareholder point of view. A number of investment banks have now moved to a buy rating on the stock, although some did also cut price targets. Nonetheless, Starbucks at a much reduced share price, worth a look. And one of the reasons for that is, despite the fact it is still trading on around 36 times last year's earnings, because it is such a well-known name, it has been commanding a premium in the market for a long time. And it does appear a phenomenon we've been talking about here for quite some time is in effect. That is, where products and brands are very well known to consumers and individual investors, those stocks tend to enjoy greater support because more investors are aware of and are comfortable and are pleased with the outlook for the products that they themselves use. So Starbucks commanding a premium simply because it is a household name. Turning to other sectors, Hyperion X, which is listed both here in Australia and in the US. You can trade on either exchange. A platinum palladium miner was up 19% last week. It's up 60% over the last 3 months, and the reasons are pretty straightforward. Not only have we seen a huge amount of catch up in platinum and palladium prices, but Hyperion X has signed a deal with the US government worth $25 million to boost titanium production. And so the strong buy rating from a number of analysts has pushed it. It's at an all-time high at the moment, and price action has been very steep, so it might not be one to leap into straight away, but rather wait for price stability, but nonetheless certainly worth running a ruler over Hyperion X. And turning to local stocks, Premier Investments was down 9% last week. Now, the concerns about the Australian retail consumer were played out in what we saw from Premier last week, just as we saw previously from Myer. But last week, Premier Investments was the biggest faller in the ASX 200. It's down 40% year to date, and that's a very bearish view on the Australian consumer. The results met expectations, but it has been argued that Premier Investments is trading at a discount. One to look at, especially if you have a positive outlook around the Australian consumer and the retail landscape.